Turbulence that has beset global financial markets in recent weeks shows no sign of abating. UK government bonds have come under particular scrutiny, prompting questions about the resilience of some businesses with considerable exposure to gilts. For AM Best TV, I'm Richard Banks. And I'm joined now by Stan Stoev, a financial analyst at AM Best. Stan, welcome.
Hi, Richard. Thanks for having me here.
It's a pleasure. Thanks for joining us. So, UK bond markets have been going through a tumultuous time over recent days and weeks. Where do we see the impact falling on the UK's insurance market?
Yes, indeed, interesting times. At AM Best, we believe that from a credit standpoint, the impact on life insurance companies segment, especially in the UK, has been quite limited. But let's go back to how all that turbulence started. It was caused by a sharp rise in the UK government bond yields, and that created an issue for pension funds, defined benefit pension funds, and particularly the ones that use liability-driven investment strategies to help manage their interest rate or inflation risk. It has been the speed at which this issue happened that created the bigger problem for the pension funds. The speed over 1 week, less than 1 week actually, pressed the companies to satisfy higher collateral calls, and this might have pushed these funds to become forced sellers of UK gilts on a market that was falling and becoming progressively illiquid. From looking from the standpoint of life insurers, what we've seen is that life insurers usually provide liability-driven investment strategies as a product to pension fund clients. And these pension fund clients are responsible for the collateral costs and the financial risk associated with liquidating assets. And thus, the risk does not fall on life insurers. However, life insurers are exposed to reputational and regulatory risk as these are related with the strategies that they provide as a product to their customers. Life insurers, from their balance sheet perspective, they're also exposed to the financial risk of hedging their own portfolios. However, we've seen that life insurers have been able to, where they use liability-driven investment strategies, they've been able to gradually adapt to the requirements for collateral calls, and what happened in last week wasn't a big shock to them. We've seen that they use more and more long-dated securities to match the pension liabilities and to support the collateral on derivative exposures.
So that's a great analysis of how we got to this situation. The Bank of England did step in to try to help out. How do we see that situation developing, and how might that affect life insurers?
Yes, indeed. The Bank of England announced a gilt buying program, and the aim was to restore the functioning of the long-dated bond space. In other words, to provide some liquidity on a market that has seen yields increasing rapidly, and with providing liquidity to curb that sharp yield increase. With those actions, providing liquidity would have helped pension funds to gradually rebuild their liquidity buffers and adjust their collateral exposures where they use derivatives. It is not expected to have a direct impact on life insurers, but the actions of the central bank would definitely alleviate any potential liquidity pressures. The bank intervened for a limited period of time. We must say that this intervention was meant to be for just 2 weeks, and it finished on 14th of October. And we had to see how this impacts the market in the medium term. And we've seen further uncertainties around the fiscal policy of the government, which was one of the drivers of this crisis. So we at Analyst continually monitor the situation and assess how this might further impact the market.
So how much is this a situation confined to the UK? And what's the risk of contagion?
Right. I mean, as I mentioned previously, it mainly affects pension schemes that use liability-driven investment strategies. And these liability-driven investment strategies are not specific for the UK market. Another market that has a widespread use of similar strategies is the Dutch one. We can ask the question, are Dutch pension schemes and life insurers exposed to the same pressures in terms of liquidity and use of derivatives as the UK life insurers and pension schemes? And yes, they will be exposed. However, this will be moderated by a few factors. One of them is the deeper bond market that the Eurozone has compared to the UK gilt market. The difference in fiscal policies and the more moderate adoption of these fiscal policies across the countries in the Eurozone. But what happened certainly should ring a bell for those schemes and insurers that use liability-driven investments, and assess the liquidity pressures that a similar situation would create for them. Assess how robust their stress tests are, and make sure that they're doing the necessary assessment of the risks, even though these risks might not crystallize in the next 6 months to 1 year.
So it's an ongoing situation. To what degree does this situation affect our outlook on the UK life insurance segment?
Yes, Richard, in April this year, AM Best revised its outlook on the UK life insurance market to stable. We've seen positive factors supporting this, such as the strong demand for pension-related products, sufficient capitalization of the companies within the segment. We need to flag as well that there were some headwinds that we've seen at the time: increased investment risk, which was driven by higher allocation to illiquid assets, increasing economic uncertainty, and the ensuing market volatility. We can see that these challenges remain under the current environment as well, and what happened in the past 2 weeks even exacerbated them. However, it's not all bad news when we look from life insurance companies' perspective. The volatility that we've seen in the last 1 month, coupled with higher interest rates, is expected to boost the demand for pension de-risking. Also, with higher interest rates, we've seen a positive impact on the regulatory solvency capitalization ratios for life insurers.
So it's important to take a long-term view. So thinking longer term, what should we be looking at as the challenges and the opportunities facing UK life insurers? Yeah,
well, I already mentioned the positive impact that the current situation has on the demand for pension de-risking solutions. Together with this, when we see increased interest yields, lower risk securities become more attractive for life insurers. Life insurers have operated in an environment of low interest rates for more than 5 years now, and in order to match their portfolio of liabilities, they've increased their investments in less liquid, higher yielding assets, and these assets carry with them a higher credit risk. With interest rates rising, we can see those those life insurers taking opportunity in investing in lower risk assets, which will lead to a lower risk to their investment portfolio. However, even with the increased investment in lower risk assets, we still expect that illiquid and high-yielding assets remain a sizable portion of life insurers' investment portfolios. These assets will still require careful management and will provide a challenge. They will test even the most sophisticated ERM frameworks.
Stan, thank you very much indeed for joining us. Some fascinating insight there.
Yeah, thanks, Richard. It was a pleasure.
For AM Best TV, I'm Richard Banks.